Most people do not fail at investing because they picked the wrong stock. They fail because they built a portfolio. They could not live with long enough to let it work. That is the real problem. They keep adding funds, changing strategies, chasing sectors, reacting to headlines, listening to one opinion this month and a different opinion the next month, until what began as an attempt to build wealth turns into a pile of positions they can no longer explain even to themselves. That is not investing. That is financial clutter. And clutter is expensive. I have spent most of my life watching people confuse complexity with intelligence. They assume the more moving parts a portfolio has, the more sophisticated it must be. More funds, more themes, more international exposure because a book said so, more bond exposure because an old rule said so, more tactical shifts because the world always feels one headline away from changing permanently. Then one day they wake up and the account is large enough to matter, but still not strong enough to set them free. That is why I like simple things. Not because simple things are easy, because simple things can be held. And the great secret in investing is that holding is where almost all the money gets made. That is why I want to talk about 3 ETFs, not as some magical trick, not as a social media shortcut. As a structure that solves 3 problems most investors face for their entire lives. You need something to anchor your money. You need something to grow it aggressively enough that time becomes your ally. And you need something that pays you while you wait, so the whole process does not feel like a promise forever deferred. Those are the 3 jobs. And once you understand the jobs, the portfolio gets much easier to build. What confuses people is that they usually start with the tickers. I start with the functions. That is the better way to think, because in every good portfolio, every asset must justify its existence. It should be able to answer a simple question, what are you doing here? If the answer is vague, the position is probably weak. If the answer is emotional, the position is probably dangerous. If the answer is clear, then the portfolio begins to feel less like a shopping cart and more like an operating system. That is what I want, an operating system. The first thing I want you to see is how serious the alternative really is. The average American family has something like a few $100,000 saved for retirement after a lifetime of working. On paper, that still sounds respectable to many people because the raw number feels large when you say it quickly. But retirement does not care what sounds large. Retirement cares what the cash flow actually is. If you try to draw 4% from a modest retirement balance, the income is usually much smaller than people expect. Suddenly, the number that sounded like relief turns into grocery money and utilities. That is when reality becomes rude. Most households are not wrecked by one dramatic mistake. They are wrecked by spending decades in strategies too weak to compound meaningfully and too complicated to maintain calmly. That is the trap. So I want to start somewhere slightly uncomfortable. You do not need a perfect portfolio. You need one you can understand, fund, and hold through boredom, fear, and time. That is a much harder standard than people think. And it is why the old Boglehead insight remains so powerful. Own broad markets, keep costs low, stop pretending you are smarter than the market every quarter, stay invested. That framework was sound because it respected human weakness. It knew that most investors do better when the system protects them from their own cleverness. I have always respected that, but I also think the world changes. And when the world changes, the jobs inside the portfolio remain the same while the tools can improve. That is how I think about this 3 ETF structure. I am not throwing away the backbone, I am updating the limbs. The backbone is simple, 3 slots, 3 jobs, no clutter, 1 anchor, 1 growth engine, 1 income layer. That is the whole design. Now, before I tell you what sits in each slot, let me tell you the 3 rules that matter more than the specific tickers. First, 1 fund per job. Not 2 because you cannot decide, not 4. Because a comment section made you nervous. 1, the point of this structure is clarity. If the anchor slot becomes 3 overlapping anchors, the growth slot becomes 2 trendy momentum funds, and the income slot becomes a junk drawer of yield products, then you have already broken the architecture. The portfolio should feel cleaner after you build it, not noisier. Second, know what stage of life you are actually in. This is where people lie to themselves. A 28-year Old with stable income, no dependents, and a 30-year runway should not build the same waiting profile as a 62-year-old who wants meaningful current income and has no appetite for watching a portfolio swing like a carnival ride. There is no shame in that. There is only honesty. The same 3 jobs still matter. But the weight placed on each job changes depending on whether you are still building, nearing freedom, or already trying to preserve it. That is not inconsistency. That is adult asset allocation. Third, consistency beats brilliance. I have never met the person whose portfolio failed because the expense ratio was 2 basis points too high on the right strategy. I have met many whose portfolio failed because they kept interrupting compounding with panic, boredom, greed, and the need to feel active. Reinvest. Keep contributing. Do not panic. Do not overreact to temporary pain. Let time work. That is the whole discipline. Now, let us build the thing. The first job in this structure is the anchor. Every serious portfolio needs a place where your money can stand without trying to perform circus tricks for you. It does not need to be the fastest thing in the system. It needs to be broad, durable, and strong enough to carry the weight of bad headlines, recessions, sector reversals, and all the noise the market produces simply because people are emotional creatures. That is why I like VTI in this slot. Vanguard Total Stock Market. The whole American public market in one instrument, thousands of companies, large, mid, and small, all sitting inside one low. Cost wrapper. This is not a bet on one story or one CEO or one industry fad. It is a bet that American enterprise in aggregate remains one of the great wealth building machines on earth. That has been a very good bet for a very long time. I like that VTI forces humility on the investor. You are no longer pretending you know which single company will dominate the next decade. You are owning the whole productive engine and letting the market itself decide who deserves a larger weight over time. That is a magnificent system. People underestimate how important that is. When you own the whole market, weakness in one area does not kill you. Technology can wobble while healthcare holds. Consumer names can slow while industrials carry more of the load. Some companies die. Fine, the fund does not become a memorial service. It evolves. New winners replace old ones. Weight shifts. The machine keeps moving. That is the virtue of broad ownership. And broad ownership matters even more when the future is uncertain, which is almost always, if I am building wealth over decades, I want a foundation that does not require me to guess correctly too often. That is what VTI gives me. It is not built to excite me. It is built to survive me. There is wisdom in that. Now look at what that means in practical terms. If you put $10,000 into a fund like VTI and reinvest everything, you are not just collecting a little dividend, you are allowing the full engine of market appreciation plus dividend reinvestment to compound behind the scenes. That may not feel dramatic after 1 year. Good, dramatic is overrated in investing. But after 10, 20, 30 years, a steady compounding machine often humiliates the more glamorous choices people spent their youth chasing. This is why I call it the anchor. Not because it cannot move, because it keeps the rest of your ambition from drifting off into stupidity. Now, once the anchor is there, people usually make one of 2 mistakes. Some stop there and become too conservative too early. Others get bored and run immediately toward whatever story is hottest. I do neither. I want a second slot that is allowed to do something the anchor is not trying to do. I want speed, not recklessness. Speed, that is where QQQ enters. Now, I know there are people who still hear that fund and think too concentrated or too volatile or too much technology. Fine, those objections are not childish. They are real trade-offs. QQ is not a replacement for the broad market. It is a growth engine sitting on top of the broad market. That is a different role. And once you understand the role, the logic becomes much stronger. In the old Boglehead framework, international stocks sat in this slot as the diversifier and growth complement. That made sense in a different world. But the world we are in now is not the world Jack Bogle was investing through decades ago. The largest American companies are not really just American businesses anymore. They are global systems wearing us listings. Apple does not depend only on American consumers. Microsoft does not build cloud infrastructure only for one country. NVIDIA is not participating in one local technology cycle. The leading companies inside the NASDAQ complex are touching semiconductors, cloud computing, artificial intelligence, software, biotech, digital commerce, and global business infrastructure at a scale that blurs the old neat line between U.S. exposure and global exposure. That matters. It means the growth slot no longer needs to be filled in the old way to achieve the old purpose. QQ gives you concentrated exposure to the companies currently doing the most to shape how the modern world functions. These are not fragile story stocks with no profits and a PowerPoint deck. These are massive businesses with real margins, real cash flow, real global reach, and enormous participation in the technologies likely to keep absorbing value over the next decade. Now here is the trade. QQQ moves harder. It falls harder. It is more expensive emotionally to hold when markets get ugly. That is the price of the growth slot. And that is why I do not put it in the anchor position. But if your horizon is long enough and your behavior is strong enough, the growth slot can do something. The anchor cannot. It can change the slope of the whole portfolio. That is important. People keep talking about average retirement balances without asking what kind of return structure produces them. The answer is usually that people save irregularly into mediocre systems and never let compounding get enough velocity. A growth sleeve with real force can change that dramatically. If a broad market fund is the machine, a well-chosen growth fund can be the turbocharger, not the whole vehicle, the turbocharger. That is how I think about QQQ. And I do not need it to be perfect every year. I need it to own the dominant drivers of a world increasingly shaped by software, semiconductors, data infrastructure, and AI-enabled productivity. If those forces keep compounding into the economy, I want a deliberate slice of my portfolio sitting close to them. That is the point. Now, here is where many investors get uncomfortable. They ask, what if QQQ drops 30%? It will someday, probably more than once. That does not refute the role. It defines it. The reason you pair a broad anchor with a growth engine is so the whole system remains emotionally and structurally survivable. The anchor steadies the machine. The growth sleeve stretches the upside together. They are better than either extreme alone. Now let us come to the third slot, because this is the one that turns a nice theory into something people can actually live with. Income growth is wonderful, but growth does not pay your electric bill while you are waiting for it. Capital appreciation is emotionally beautiful until the market decides to take a long, cold walk sideways or downward for a while. That is where many investors discover the hidden weakness in a pure growth mentality. If the portfolio never sends cash back, the whole system can start feeling abstract. That is why I like SHG in the third slot. This is where the original bond sleeve gets upgraded for the world we actually inhabit. Bonds had a long and honorable career in the classic three-fund model because they offered income and stability. Fine, but a fixed coupon has an obvious ceiling, and in an inflationary world, that ceiling can become a kind of prison. Your cash flow remains polite while the cost of life becomes rude. I do not like that trade nearly as much today. SHG solves the problem differently. Instead of lending money and accepting a fixed return, you own companies with strong balance sheets, real profits, and long records of paying and growing dividends. That matters because a growing dividend is a living thing. It can keep pace with the economy better than a fixed coupon can. You get current income, potential dividend growth, and share price participation all in one structure. That is a very powerful combination, and unlike QQQ, South Carolina HD tends to be populated by sturdier, more mature businesses that do not need technological romance to justify their existence. These are firms that generate cash, return cash, and often remain standing when the market becomes less forgiving. That is exactly what I want from the income slot. Notice what happens now. The anchor owns the broad productive base. The growth sleeve pushes the upside. The income sleeve pays you while the other two continue doing their work. That is a complete machine. And it is much better than the false choice people often give themselves, either pure growth and no current income or pure yield and no real growth. Why choose when the portfolio can assign different jobs to different sleeves? Now, I want to be honest about income because people become childish around it very quickly. The income slot is not there to replace your salary next year from a tiny account. This is where internet finance destroys common sense. People think a few $1,000s in an income fund should somehow produce life-changing passive cash flow immediately. It produces proof. First, then scale later. The proof matters. You see the dividend arrive. You reinvest it. The new shares produce more income. That income produces more shares again. And over enough time, the line between nice little cash flow and meaningful monthly support becomes much less imaginary than it looked in the beginning. That is the beauty of a dividend growth sleeve. The early dollars are small. The lesson is enormous. Now let us put the three together, because the combined logic is what makes the structure so attractive. VTI gives you breadth. QQ gives you acceleration. SHE gives you cash flow plus a calmer source of equity exposure. That is why equal weighting is such a clean starting point. You are not trying to prove genius. You are letting each part do its job. The portfolio has an identity. Now, it is not just a pile of ticker symbols. It is a system with a backbone, and the numbers begin to reflect that. If you put $10,000 into a 3 ETF structure like this and let it sit, reinvesting all dividends, the growth over long periods can become extraordinary relative to what most families actually end up with. That is the whole point the source material was making, and it is a point worth preserving. The gap between average retirement reality and what disciplined, low-cost, long-duration investing can produce is not small. It is life-changing. That is why I think the $10 a day example matters so much. Not because $10 is magical, because $10 is ordinary enough that most people dismiss it, and that is exactly what makes it powerful. If you can take something ordinary and make it consistent, the market does the rest in a way that looks almost unfair to the person who never started. That is how compounding always feels in hindsight. Embarrassingly obvious if you invest $10 a day, every day, across a structure that actually has a logic to it, and you keep reinvesting, then over 10 years the account no longer looks symbolic. Over 20 years it starts looking serious. Over 30 years it can look like something the younger version of you would have called impossible. That is why the daily amount matters less than the duration. People keep searching for the perfect lump sum while ignoring the more repeatable miracle of regular contributions plus time. That is where million-dollar outcomes quietly come from, not from one big stroke of brilliance from repetition. Now let me say something about risk, because every good portfolio conversation eventually becomes a behavior conversation. The real risk in a 3 ETF portfolio is not that the ETFs are too simple. The real risk is that the investor is too emotional. He buys QQ because he loved the last 5 years and sells it after the next bad 12 months. He buys SGG because the dividend looks comforting and then abandons it because the share price underperformed in a risk. On Sprint, he holds VTI until the next recession and suddenly decides the whole market is broken forever because headlines always sound permanent at the bottom. That is how people sabotage even good systems, not through bad products, through bad behavior. That is why I care so much less about squeezing tiny percentages out of portfolio optimization and so much more about whether the structure is psychologically livable. Can you hold it when it is boring? Can you keep funding it when it feels slow? Can you keep reinvesting when the narrative gets ugly? Can you let 30 years do 30 years of work? If yes, then the system has a chance. If no, then no allocation will save you, because the failure point is not the market. It is the person. This is why I keep returning to the same philosophy. Build a portfolio that respects your own weaknesses. Do not demand that your future self become a different species. Give that future self a structure he can survive. That is what this 3 ETF design does very well. It reduces the number of decisions, it gives each part a role, it creates balance without clutter, it lets you tilt more toward growth if you are young, more toward income if you are older, without abandoning the core architecture. That is intelligent flexibility. And this is where I think the source material was especially right. The original Boglehead model still contains profound wisdom. But wisdom is not the same thing as freezing the world in 1985. The jobs remain, the tools can improve. We still need breadth, we still need growth, we still need stability and income. But in a world where leading-us companies already carry enormous global exposure, where traditional bonds can feel less compelling in real terms, and where investors still desperately need simplicity, this updated version deserves real respect. Now, none of this means international exposure is worthless. None of it means bonds never matter. That would be childish. It means this particular structure is one of the cleanest ways for an ordinary investor in 2026 to own a broad base, a concentrated growth layer, and a rising income stream without turning his portfolio into a chaotic museum of half-believed ideas. That is what makes it so useful. And I will tell you something else. There is moral value in a clear portfolio. I mean that seriously. Clarity reduces fear. Clarity reduces self-deception. Clarity lets you explain your own money to yourself in plain language. This piece owns America. This piece owns the future drivers of global business. This piece pays me while the other two keep working. There is power in that. A person who can explain his portfolio can usually keep holding his portfolio. A person who cannot explain it is often one scary headline away from abandoning it. That is why I do not want people building accounts they secretly do not understand. Now let me bring the whole thing home. What makes a great portfolio is not that it looks impressive on a chart shared online. It is that it can carry you across time. It can absorb your inexperience in the beginning. It can survive your fear in the middle. It can still be there in the end when you need the income, the growth, and the flexibility to have all compounded into something real. That is the test. And when I put this 3 ETF structure against that test, I like what I see. I see an anchor sturdy enough to keep you from drifting into nonsense. I see a growth engine strong enough to keep you from settling for mediocrity. I see an income layer steady enough to keep the whole journey from feeling like an act of faith. That is a beautiful design. Not because it is exotic, because it is usable. So if I were starting with $10,000, I would not spend my time trying to find the perfect 10 stock basket or the perfect sector rotation strategy or the perfect entry point that always feels 1 month away. I would build the machine, and if I were starting with $10 a day, I would do the same thing, because in the end, rich people are not usually the people who found the most exciting idea. They are usually the people who found a strong structure and stayed with it while everyone else kept getting distracted by the shiny object of the month. That is how you get rich. Not with more funds, with more years, not with more opinions, with more discipline, not with complexity, with clarity. And that is why if you ask me what the smartest portfolio this year may really be, I will give you an answer simple enough that some people will underestimate it. 3 ETFs, 1 to anchor, 1 to grow, 1 to pay. Then leave it alone long enough that the market starts doing what most people never give it enough time to do. Make you very rich very quietly,